In late 2022, a single AI demo ignited a frenzy. Within months, $50 billion flooded into startups with little more than code and hype. Tech giants and investors raced to avoid missing out, convinced this boom was different from the bubbles of the past. But how far can belief and borrowed billions carry a revolution before the cracks begin to show? The answer could change who wins and who loses everything next. November 30th, 2022. A new website appears online, ChatGPT. In less than a week, 1 million people are talking to it, testing its limits, sharing its answers across every corner of the internet. 5 days. That is all it takes to reach a milestone that took Instagram 2 months and TikTok 9 months. By January, ChatGPT is drawing over 100 million monthly users, its name topping Google searches and dominating social feeds. Hashtags trend. YouTube explodes with demo videos, tens of millions of views in days. Twitter lights up with 500,000 mentions in a single week. What began as a research project becomes a cultural event. In offices and group chats, the question shifts from, what can this do, to what if we miss out? Tech giants scramble. Microsoft, Google, Amazon, each racing to claim a piece of the future. Investors and founders repeat the same phrase, AI will change everything. It is more than a product launch. It is a psychological tipping point. The old rules, caution, proof, patience, are swept aside by a new urgency. The belief takes hold that intelligence itself has become a platform, and whoever moves fastest wins. Within weeks, the air is thick with possibility and fear. The world has seen viral apps before, but never one that promises to rewrite how we think, work, and create. The gold rush begins not with code, but with conviction. The future, it seems, is up for grabs. Surged money surged into the AI sector with a speed and intensity rarely seen in financial history. In the first half of 2024 alone, venture investors poured $50 billion into AI startups, a sum that eclipsed entire years of funding in previous tech cycles. Boardrooms buzzed with talk of winner-take-all races. Top venture funds like Sequoia and A16Z began funneling 30 to 60% of their portfolios into just a handful of AI bets. The pressure was relentless. Term sheets for new deals cycled in days, not months. Some startups leapt from demo to valuations of $100 million in under 3 months, driven less by revenue than by viral buzz and the pedigree of their founders. Corporate giants did not wait on the sidelines. Microsoft, Google, Amazon, and Meta paid steep premiums for stakes in promising labs, sometimes outbidding each other just to secure access to the latest models or talent. By mid-2025, strategic investors made up 3/4 of all late-stage AI deal value, a shift from the more fragmented funding of past booms. The logic was simple. Buy in now, or risk being left behind as the next wave of intelligence reshapes the market. Velocity. Deal velocity became its own metric. Startups that once struggled for attention now fielded multiple offers in a week. Valuations at the seed stage soared 42% above peers without AI, and Series A rounds routinely cleared $50 million, with revenue multiples hitting 25 to 30 times annual sales. The numbers reflected not just optimism, but a collective anxiety, fear that missing the next breakthrough could mean missing out on the future itself. Inside a humming data center, the operations manager glances at the utility meter. Numbers climb. Training a single large AI model now draws as much electricity as a small city, hundreds of megawatts, every hour, every day. Each server rack is packed with rare earth GPU processors, sourced from mines across the globe, their supply chains stretching from Congolese cobalt fields to Taiwanese chip foundries. Supply chains. The cooling system gulps water, millions of gallons at a time. In the Dalles, Oregon, Google's data center now rivals the town itself for water use, sparking disputes with local officials and residents who worry about summer shortages. The manager negotiates with city planners over permits and power lines, knowing that every new model release means another spike in demand. Energy bills soar, but it is not just about cost. The grid strains under the load, and expansion plans stall as towns push back. The physical backbone of AI is no longer invisible. It is measured in gigawatts, gallons, and minerals, each one a new point of friction as the gold rush collides with the limits of the real world. The numbers on the screen don't tell the whole story. Beneath the headlines about viral growth and billion-dollar valuations, a quieter calculation is taking place. AI startups, flush with investor cash, are also piling up debt at a rate rarely seen in tech. It's not just equity anymore. Venture debt, convertible notes, and short-term loans have become standard tools for keeping the lights on. In 2024, United States AI startups took on $13.2 billion in new debt, with late-stage companies often borrowing $25 million or more just to fund their next training run or secure another batch of GPUs. The debt-to-equity ratio for infrastructure-heavy AI firms now sits at 0.77, meaning for every dollar of equity, there's 77 cents of debt on the books. Some, like CoreWeave, have gone further. A $7.5 billion debt facility in 2024 pushed their leverage past 1.4. The CFO at one fast-scaling lab runs weekly stress tests, watching interest payments climb as revenue projections lag behind. The bet is simple: borrow now, grow fast, and hope future profits arrive before the bills come due. But if growth slows, the math gets ugly fast. Cloud invoices arrive, and the numbers don't add up. For some AI startups, monthly cloud bills now rival their entire annual revenue. In 2024, Stability AI nearly defaulted after burning through millions in just a few months, its survival hanging on a single funding extension. Across the industry, CFOs watch as infrastructure costs spiral, with cloud spend sometimes doubling quarter over quarter. The scramble to keep models running has pushed some labs to cut corners, turning to synthetic data when real-world sources run dry. But as more models train on AI-generated content, researchers warn of model collapse, where quality and reliability quietly degrade, and nobody notices until it's too late. The pressure isn't just on the balance sheets. In Manila, a customer support agent receives an email. Her job is gone, replaced by a chatbot that never sleeps. She's not alone. In 2025, layoffs swept through business process outsourcing firms across Southeast Asia as automation took hold. Official reports count tens of thousands affected, but behind each number is a story of skills lost and futures rewritten. The promise of AI, for many, arrives as a pink slip. In the world of artificial intelligence, growth has become something close to a belief. Founders and investors talk in metaphors. AI is not just a tool, it is the new electricity, a force that will power every industry and change the very fabric of the economy. Pitch decks promise trillion-dollar markets and endless disruption, but the math behind the scenes tells a different story. Private investors are paying 25 to 30 times annual revenue for a stake in the next big thing, multiples that would have seemed absurd even at the height of the dot-com boom. The logic is circular. Higher valuations attract more money, and more money fuels higher valuations. Startups with little more than a viral demo or a famous founder leap from prototype to billion-dollar status in a matter of months. The faith is contagious, and so is the fear of missing out. Few pause to ask whether these numbers reflect real value, or just the latest chapter in a long tradition of financial wishful thinking. Court filings hit the wire. The Authors Guild, joined by bestsellers like George R.R. Martin and Jodi Picoult, sues OpenAI for training its models on copyrighted books. The complaint lands in federal court, demanding damages that could reach hundreds of millions and threatening to unravel the legal foundation beneath every generative AI product. Investors, once unfazed by warnings, start to flinch. On March 5, 2025, Bank of America downgrades NVIDIA, citing rising cloud costs and signs that AI demand is flattening. Headlines ripple through trading floors. Analyst skepticism spreads. Oracle reports a $100 million quarterly loss tied to AI data center rentals, and Morgan Stanley cuts its rating, warning that capital poured into AI may not be recouped. In startup offices, the mood shifts. Chief financial officers scramble to find cash. Some labs miss I roll. The market's belief engine has met its first real spark, and the air feels suddenly thin. Today, AI investments outpace profits, and speculation crowds out substance. As trillions ride on algorithms, the line between innovation and illusion blurs. The real risk isn't just financial, it's mistaking momentum for wisdom. Progress demands vigilance, not faith. The future will judge what we choose to question now.